The Fed hasn't pivoted. The investors as a class have not pivoted. Where have we seen a pivot? We've seen a pivot in the market, actually, in terms of leadership and in terms of strength. Good afternoon, everybody. Willie Dellwich here. Glad to be with you today. Glad you're tuning in to hear some Townhall Takeaways. Just got done with our All-Star Charts Plus weekly Town Hall. Went through a bunch of interesting charts and tables and want to now share some of those key takeaways with you. And I think the theme of the day, the theme of the week really has been pivot. And that's where we're seeing, where we want to focus, where we're seeing evidence of things that are pivoting and maybe where we're not seeing evidence of pivot. And so we'll start with the Fed meeting that we had this week. Jerome Powell raised interest rates by another 75 basis points. There was some talk, some hope that maybe that would be followed by evidence of a pivot on the part of the Fed, that they would kind of ease the glide path, talk within a more conciliatory tone about what's happening in the market. That isn't what we got. The market got instead Powell suggesting that the Fed is not done, that they're going to continue to raise rates at a pretty accelerated pace. Maybe not what we've seen over the past four meetings where it was 75 basis point rate hikes, but still remaining accelerated, still more work to be done. And so one of the key takeaways I think is, as the Fed is not pivoting, we need to keep in context what the market does in these accelerated rate hike environments. And the historically is pretty clear. In all rate hike environments, stocks, and they end up pretty much okay. When the Fed has accelerated those rate hikes, when it's a lot of hikes on top of each other, stocks typically struggle. They go sideways at best for a year plus after the beginning of that rate hike cycle. What does do well historically is commodities. Commodities tend to do well when the Fed is raising rates at an accelerated pace. In fact, commodities tend to do as well under accelerated rate hike cycles as stocks do under gradual tightening cycles. And we've kind of seen that play out this year. We're, year-to-date returns, the S&P's down 20%, commodities are up 20%. And so that's the takeaway. No pivot on the part of the Fed. That if history is correct, then that could mean stocks continue to struggle, commodities continue to do well. So we can look at it also, evidence of a pivot on the part of investors. Have investors changed their behavior given what they've seen from the Fed, given what they've expressed in terms of sentiment all year? And you look at ETF flow data, and no, investors are not pivoting. The love affair with stocks remains deeply intact. $300+ billion into equity ETFs this year. October had largest month of this year with equity ETF inflows. And that's for an asset class that is struggling this year, down 20%. Bonds are no great shakes this year either. Aggregate bonds are down 15% year to date. Bonds continue to get inflows as well. Commodity ETFs, that's where we're seeing strength. It just talked about up 20% year to date. Commodity ETFs actually net outflows this year. So investors love affair with stocks, not so interested in bonds, not paying any attention at all to commodities. You see that also in the AAII asset allocation survey. Yeah, weekly survey shows a lot of pessimism. Asset allocation survey, equity exposure on the household level, just back to historic levels. Investors remain underweighted, have underweight exposure to bonds. Cash this past month jumped up above its long-term average, but nowhere near what we've seen in terms of washout levels in the past, especially given this quote unquote sentiment environment that we're in, where there's all this rampant pessimism. So the Fed hasn't pivoted. The investors as a class have not pivoted. Where have we seen a pivot? We've seen a pivot in the market, actually, in terms of leadership and in terms of strength. Long-term trends of showing tech leadership, tech dominance have turned over the past couple years. We can look at this especially in the small cap value versus mega cap growth ratio, where small cap value is at its highest level of the year, moving up against its peak from last year. And I think what really tells the story here gets to the weightings that we see inside these ETFs. Mega cap growth, nearly half of it is tech, less than 1% of it is energy, versus small cap value, IWN, equal balance, 6% tech, 6% energy. This is really a market where performance comes down to, do you have tech exposure? Do you have energy exposure? Investors haven't pivoted away from tech exposure and into energy exposure. The market is doing it for them. You can get on board and lean into that trend. If you're an investor, you can follow this long-term turn that we're seeing, represented small cap value versus mega cap growth, or you can sit back and drift in the market and let the market adjust for you. That's all well and good when the market's going in the right direction. Time in the market is not such a blessing if it's heading in the wrong direction. And I think this is a time where investors eventually are going to wake up to the fact that the Fed isn't pivoting and will have to start to do some pivoting of their own, because the market is sending that signal. That's what we're looking for. That's what we're seeing. So to wrap it up, the Fed has not pivoted, continue to raise rates aggressively. That's a headwind for stocks. That's a tailwind for commodities. Investors have not pivoted. They continue to have a love affair with stocks and ignore commodities. Market is pivoting. Tech is getting blown up. Energy is starting to do well and move to new highs. On a relative basis, also starting to see that some of that on an absolute basis as well. So those are the takeaways. Thanks for joining me. We'll do this again every Thursday afternoon. Willie Delwich saying have a great week, everyone.